So the hyperscalers, all of a sudden, their need for more data centers exploded.
In 2022, their revenue was about $16 million. In 2025, $5.3 billion.
Frightening. It's unbelievable.
There's nothing else like CoreWeave out there. A data center is basically a warehouse for computers.
Land rich, people poor.
The type of chip that you need to train and run these AI models is very power hungry.
Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. Today we're going to explore data centers and all their tangents. And with me to help us explore it is Nick Del Deo, who is the digital infrastructure analyst at MoffettNathanson. Welcome, Nick.
Yeah, thanks for having me, Steve.
So I was thinking about how to start this, and I was thinking, if we were talking about banks, and I had a bank analyst on, the bank analyst and his team would have literally almost all the banks that are relevant under their actual coverage. Mm-hmm. There'd be no bank out there in some outside world that wasn't under their coverage. They would, all the information they would actually be covering. But in your case, you cover data centers and a couple of other things, which we're going to get to, but so much of your space is actually not technically in your coverage.
That's right.
You say that's fair?
Yeah, absolutely. You look at the currently publicly traded data center stocks. There's Digital Realty and Equinix. And that's about it.
And there used to be more.
There used to be more. In fact, a number of them went private. And I think what you've seen over the last several years is a lot of the data center construction has been happening in the private markets rather than the public markets. A couple of reasons for that. The sheer volume of capital required, I think, has spooked public investors. The accompanying cash flow profile is not something that public investors tend to like. If you pitch a story that we're going to spend a bunch of money and be negative cash flow for years and years, and maybe 5 or 10 years down the road we'll have a payoff.
Public shareholders don't like that.
They don't like that at all.
So let's take a step back for a sec.
Mm-hmm.
Let's lay out for everybody the entire landscape of data centers. What are hyperscalers? What are data centers? What's CoreWeave? Lay out for me all the players that basically encompass your space, whether you cover them technically or not.
Sure. So if we think about a data center is basically a warehouse for computers. It's got a lot of power available. It's got power backup systems, cooling systems, security, fire suppression systems, basically a purpose-built space for IT equipment. Players like Digital Realty and Equinix are landlords who own the buildings.
Just the building.
Just the buildings. Then you have customers who use the buildings. So that could be someone like a hyperscaler. It could be a corporate enterprise.
Define hyperscaler.
So hyperscaler, typically think of it as 4 players. So Amazon, Microsoft, Google, and Meta. Basically people who invest in IT infrastructure at a scale that's just unmatched globally.
And 10 years ago would have been unfathomable.
Yes. So you have a variety of different types of customers, whether it's hyperscalers, corporate entities, network service providers, and so on. You have public data center operators like Digital Realty and Equinix. You've got a host of private operators, CyrusOne, QTS, Vantage, down the list. You have fiber operators who operate the fiber that connects the data centers to one another. So that could be like Lumen, Zayo, Cogent, Crown Castle, AT&T, Verizon, down the list. You have players like Dycom or Mastech who will construct the fiber. Players like Corning who supply the fiber both inside and outside of the data centers. You have equipment suppliers, NVIDIA, Intel, AMD, Cisco, and so on that provide the Dell, provide the equipment that goes inside
the GPUs and the servers.
Yeah, the servers, the GPUs, the CPUs. So there's a whole stack. And then there's some, the lines aren't always clear cut in terms of who does what. Someone like a Microsoft is a big customer of the data centers. They lease a lot of space for them, but they will also own their own facilities in many cases. So there's a mix of owns and
So
lease.
Microsoft might lease a building from Digital Realty and put all its stuff inside, and then 2 miles down the road, just simplistically, they might own their own building and put all their stuff in there as well.
Yes.
So they do both.
They do both.
Okay.
Yes. So sort of like how an Amazon might own some and lease some warehouses, the hyperscalers would do the same thing.
Can you give us an idea of how much CapEx is actually going on in this space right now? Because when you add it all up, who's spending what? I mean, the numbers that get thrown out are astronomical.
Yeah. I mean, the simplest way that people look at it is to sum up the CapEx that the hyperscalers spend each year. And that, I think in 2025, that's supposed to be $350 billion or so, up substantially over the past several years and expected to grow further in the coming years. Now, it's a little bit, I don't want to say misleading, but it's a bit murky in terms of where that money goes. So when you think about the cost of a data center, it's generally in the low teens, millions of dollars per megawatt.
I'm sorry, say that again.
So to build a data center, you typically quote it in terms of megawatts, the power capacity that the data center offers.
I see.
And it's usually, they'll call it low teens or so, millions of dollars per megawatt. So if you build a 100 megawatt data center, it's going to cost you, $1.2 billion or so, right?
That's more than obviously just the building. It's everything that's going to go into the building.
Yes.
Okay.
Or actually, no, that is the building.
Just the building.
The stuff that goes inside is 3 to 5 times the cost of the building. So
the building that Digital Realty and Equinix builds for this 100 megawatt entity, you're saying is about $1.2 billion to build just the building.
Yeah, 100 megawatts. Yeah. And then you've got the again, the stuff that goes inside is multiples of that.
Right.
So when you look at the CapEx of the hyperscalers, the bulk of that is actually on servers and IT equipment, networking gear that goes inside data centers rather than what they're spending on data centers themselves. To the extent that they lease facilities, that's generally not showing up in CapEx. That's showing up as a lease.
Right.
If you look at the CapEx for the data center operators, right? So again, people who focus on the buildings, not the stuff inside, that's obviously been up dramatically over the last several years. But again, a lot of it's happened in private hands as opposed to public hands.
So just for viewers to understand, there used to be a whole bunch more public companies that competed with Digital Realty and Equinix, and they got taken private by private equity, and now they're private and they're operating. But they're still competitors.
They're still competitors, but QTS was public. It got acquired by Blackstone, who's funneled enormous sums of money to grow that business. CyrusOne was taken private by KKR and GIP.
So let's dig down a little bit to the 2 data center companies that you cover. They're REITs, which basically means they pay out a very high percentage of their cash flow as dividends. They don't really retain capital. So if they want to grow, do they have to constantly raise capital to basically keep growing? Is that the way it's structured, or can they grow from internal cash flow?
And that's been one of the sore points among public investors is that data center operators who've been public have had to consistently access the capital markets to grow, given the magnitude of the investment opportunities they have, and having to pay out a substantial portion of their cash flow as dividends. Now, I think at the end of the day, it's a little more nuanced than that, right? So if you're a real estate operator and you can qualify as a REIT, you don't have to pay corporate level income taxes. So you eliminate double taxation. There's a real value to that. So I think if you zoom out, you're basically trading off not paying corporate income taxes for maybe having to issue equity over time. I think net that's a benefit for the industry. But it certainly means that they have to lean more on the public markets to access capital than most other providers would.
I mean, these companies years ago were not REITs. Then they converted to REITs.
Yeah, well, if you go back to Digital Realty, when they launched, I guess it was probably 20 years or so ago as a public entity, they've always been a REIT.
Equinix was not a REIT.
Equinix converted, that's right. They took a similar path as what the tower operators did. Qualify as a REIT, but so long as they were early in their growth cycle and had negative taxable income, there was not necessarily a point to being a REIT because it simply imposed that dividend payout requirement on you without a commensurate benefit. Once they got to a point where their taxable income was going to come positive, then it made sense to flip over to a REIT and avoid paying it.
So are the private entities that used to be public growing a lot faster than Digital Realty and Equinix?
Yes.
How much faster?
Hard to put exact numbers on it, but QTS, for example, I saw a stat that they've leased multiple gigawatts of capacity that they plan to bring online over the coming years, which would actually, from the time that they were public, they were substantially smaller than Digital Realty. I think if you zoom out from a capacity perspective and look forward a few years, they could be twice as large as Digital Realty. So really pressing the gas in terms of the amount of capital that they're willing to put into the business, the way that they finance it, so willing to put a lot more debt on it and use some creative financing structures like ABS, and potentially explore some different markets to really accelerate that growth. If you're a public operator, again, you've got to worry about your AFFO or EBITDA trajectory over time, and it makes it harder to really lean as heavily into the investments as you would as a private entity if you're willing to sustain higher leverage or willing to defer the benefits from a cash flow
So
perspective.
the private companies, they're more levered than the public companies?
Yes.
How much more?
It depends, but it could be twice as high.
Twice as high?
Yeah.
So are there any shareholders out there who are advocating that these companies de-REIT?
No.
None. Why not?
Well, then you incur the
But you could
corporate income
retain
tax.
capital, you could grow more.
Yes, but
Right.
again, the effective solution to that is going private.
Going private.
And Digital Realty and Equinix, in practical terms, are too big to go private.
How big are they now?
Yeah, so from an enterprise value perspective, I'm going to say Equinix is probably in the $90 or $100 billion zone, and DLR is probably in the $75 billion zone.
And how big were QTX and CyrusOne when they got taken private?
Oh, good question. They were probably, I'm going to say, in the 20 billion range.
Okay, so much more manageable
Yes,
in terms of
yes.
size.
Yeah, so still a decent take private valuation, but not in the same league.
In terms of size.
Yes.
So it was easier to fund.
Yes.
Interesting. Okay. Let's talk about, let's go to Digital Realty and Equinix right now.
Sure.
So why don't you describe the difference between the two companies in terms of where they focus their business models? Because historically, Equinix was always used as a better company, used to trade at a higher multiple. These days, the multiples are roughly the same. Just walk us through the whole story of these two companies. What do they do? How are they different? What are the managements like, et cetera?
Yeah, so I think you're right. Historically, Equinix was viewed as the clearly superior asset. And the reason for that is because Equinix's niche is quite a bit different than Digital Realty's. People tend to view data centers as this monolithic industry. But in reality, there are a number of different business models or data center types that are out there, and they have different profiles to them. You can kind of break it down into three categories, right? Call it hyperscale data centers or very large data centers, where you would host acres of servers for folks like Microsoft or Google or Amazon.
And there might be only one tenant in the building.
Yeah, in some cases one, some cases a handful.
Okay.
But historically, that's been a fairly, maybe not commoditized, but a very competitive niche of the market.
And why is that?
Well, because if you were to build a data center and I had a data center, there's not a lot to differentiate it, right? So long as they're in similar region, similar proximity to a key interconnect point, which we'll get back to, similar size, similar age, not a whole lot different about them. You've got another group of data centers that are focused more on serving enterprises. So
What do you mean by enterprises?
So think of J.P. Morgan or Walmart, big users like that.
Normal companies.
Yes, exactly. So maybe
As opposed to the Amazons of the world.
Exactly.
Okay.
Exactly. So think, J.P. Morgan wants to run some of its internal systems, but it doesn't want to put it in the cloud.
Right.
That might go in a corporate type data center or an email system, a disaster recovery system, those sorts of things. And then the third type is, an interconnection focused data center. And these facilities are ones that really cater to companies looking to be in close proximity to some other counterparties with whom they want to exchange data.
Like, give me an example.
So, if we go back to the dawn of the internet, right? So the dawn of the internet as we know it, the late 90s. Let's say that AT&T needed to exchange traffic with Verizon, BT, Deutsche Telekom, Comcast, down the list. The most efficient way to do that is for everyone to put their equipment in one data center and then run cross connects or cables from there.
In between their servers.
Exactly.
Right.
Exactly. So a business model kind of cropped up, and Equinix really led the charge here, but to build these purpose-built neutral facilities.
What do you mean neutral?
Neutral, as in they didn't have a stake in the business. One of the challenges before this time was that if let's say AT&T wanted to get access to a Sprint facility. Well, Sprint would kind of try to use it as a competitive advantage, really jam them on the price, make it inconvenient to do that. Equinix said, we're going to treat everyone equally.
We're Switzerland.
Exactly. They're Switzerland. So what happened is for these interconnection-oriented facilities in which Equinix is the leader, networks came in to exchange traffic with one another because no network is ubiquitous. They all need to hand off traffic to one another to get data where it needs to go. It's we learn about network effects in business school, and this is a literal network effect, right? If you go to an Equinix facility or a Digital Realty facility that's oriented along these lines, there could be hundreds or thousands of cables between customers in the facility, just a spider web of cables between their gear.
So you're talking about it basically a data center where almost all the servers from different companies are actually connected to one another.
Yes, primarily the networking gear.
Right.
That's right. And so what you've seen historically is that these interconnection-oriented data centers kind of form the hubs in key data center markets, because that's where data comes in and out. And then these other facilities, the enterprise facilities or the large footprint or hyperscale facilities, will tie back to those interconnect points.
I'm not following. What do you mean they tie back to those interconnect points?
So in other words, a network service provider's network is going to terminate in Equinix, and then there's going to be fiber from a hyperscale facility back to Equinix.
I see.
Right?
Okay.
So Equinix is sort of the connectivity hub. And what you've seen happen over time is with that network foundation in place, a lot of content and digital media companies decided to co-locate in Equinix to take advantage of the network access, pump out their content to eyeballs. Over time, you saw the cloud service providers put in on-ramps to their platforms. So on-ramps are basically the physical equipment where customers can directly access the cloud. Mm-hmm. You think of it as an on-ramp to the Jersey Turnpike.
Okay.
Right? And then you saw enterprises go into Equinix so that they could access the cloud providers directly.
So this service that I guess what Equinix was providing was proximity to everybody else,
yes,
so that your data flows a lot more quickly, has real value.
Yes, think of it as akin to the Chicago Merc or eBay. In essence, it's a marketplace.
Right.
So if you want to exchange traffic directly with the counterparties in Equinix, you go to Equinix.
Right.
And everybody goes to Equinix because everyone is at Equinix.
So it feeds on itself.
Exactly.
Okay.
So Equinix has historically been the leader in that space, and it's a legitimately differentiated model that's hard to replicate. If you or I built a data center next to Equinix and tried to offer,
but we don't have the network at that point.
We can't do it.
So, okay.
You can't replicate.
So they had a real competitive advantage with the creation of this network that feeded upon itself. Everybody wants to be in Equinix because of the interconnectivity.
Exactly.
And I think which breeded more interconnectivity.
Precisely.
Got it.
So what you've seen historically is that Equinix or other interconnection-focused operators, there was CoreSite, which was public, that was acquired by American Tower. There was Interaction in Europe that was acquired by Digital Realty, and a handful of others. They tended to generate returns that were much, much better than the remainder of the industry.
And now explain how much more profitable it is to have this type of networking data center versus a plain vanilla data center.
As I measure it, if you were to go back, say, 3 or 4 years before the AI boom, which has flipped things around a little bit, and we'll talk about that, the return on invested capital for guys focused on hyperscale facilities or more vanilla enterprise facilities wasn't terribly different than their cost of capital.
And the cost of capital would be roughly what?
Yeah, we'll call it
10%?
At that time. No, probably 7%, 8%.
So your ROE is equal to 7%. It's not great.
Yeah, it's not. And that's why if you looked at the AFFO per share growth for those companies over time or their stock price performance, it was a struggle for them. Mm-hmm. Whereas Equinix, and you could look at CoreSite, again, similar business model, was also public at the time. Their ROIC was probably in the low to mid-teens.
Oh,
so
basically
meaningful
double
difference. Yes,
that's meaningful.
Yeah.
Okay. And only just because you're putting wires in between people in the back of the servers.
Exactly.
So you can charge more.
Exactly. It's a classic network effect.
Right.
Now, fast forward to 3 years ago, where the AI boom really started, and it's continued through today. The sheer volume of capacity that players like Microsoft and Amazon or OpenAI are demanding has kind of shifted the landscape a bit.
So the hyperscalers, all of a sudden, their need for more data centers exploded.
Yes.
Because they need to create more and more of these.
Yeah, and more specifically, the GPUs, the type of chip that you need to train and run these AI models is very power hungry. And the way you get to more powerful models is by putting more and more of these chips together in one location. So it sort of upended the data center landscape a bit in that it introduced legitimate supply constraints. So in other words, the amount of capacity that the hyperscalers and others were demanding was greater than what the industry could supply. Mm-hmm. And you saw pricing for larger footprint space, which historically declined year over year. Over the last several years, it's probably doubled.
Okay.
So you've seen returns on these larger builds improve dramatically.
How much more would you say, from the 7% return on
It's probably capital? You call it from 7 to 8%. Everybody defines it a little differently, but it's probably low teens today.
Okay, so almost up to the Equinix return on investment capital.
Yeah, but not only that is, you've got a bigger spread between your cost of capital and your return, but a much larger volume of capital that you can invest behind it. So you get both the return benefit and the amount of capital you can deploy has gone up. So that's really benefited players who focus on that part of the market.
Which is digital realty.
Yeah, as a public player, digital realty has been a real beneficiary, plus a lot of these private players. Equinix, nothing about their value proposition has been eroded, but at least to date, AI has really benefited, or it's really been focused more on model training, creating these models as opposed to inference or the usage of these models. Training AI models, it's not latency sensitive.
I know what that means, but I'm not sure all our viewers do.
Sure.
Explain what that means.
So latency sensitive means close to the people who use it. If you were to look at where, say, Equinix has its data centers, they're in tier 1 markets. So think New York, Silicon Valley, Chicago, London, Singapore, Tokyo. They're not out in the middle of Wyoming.
Right.
Because where the networks terminate is generally close to where they again, you want to reach the eyeballs. AI
so if your
training,
eyeballs are in New York, you don't want your data center to be in Alaska.
Exactly, because it takes time
to get there.
Right. So it leads to a poor experience for the customer. AI training is not latency sensitive because it's a process that could take weeks or months. It's power hungry, so the cost of power and availability of power matters a great deal, and you need a lot of land. So what you've seen is that these
So you could be in Alaska.
Yes.
In theory.
In theory.
In theory.
In practice, what you've seen is a lot of these facilities crop up in places like Texas, North Dakota, Wyoming, Iowa.
Land rich, people poor.
Yes. Yeah. A lot of land and power availability.
Right.
That's been the biggest constraint.
We're going to talk about power. We'll get to that.
So, so we've seen the folks who are more willing to focus on or who focus more on these larger deployments have really benefited, either because they host these deployments directly or because these deployments have just sucked up all the available power such that there's scarcity for what remains. What's happened is there's been a bit of a flip in investor sentiment where people view the players focused on the hyperscale opportunity or the AI opportunity as much more interesting than Equinix, which has not seen the same sort of benefit, at least not yet.
And that's because all of the AI action is really in the language models that are being created, as opposed to there's no great apps yet.
Yes,
there's some. There's ChatGPT, there's Perplexity, but there's no. I'm not on my phone every single second of the day doing something in AI yet. And when that happens, that'll benefit Equinix.
Yeah, a little more nuanced, but yes, I think some AI applications will remain latency insensitive.
So
think like deep research, OpenAI deep research, where you ask it a question, 5 minutes later, it comes back to you with a research report.
It doesn't matter whether it's 5 minutes or 4 minutes.
Yeah, or more precise, 5 minutes or 4 minutes and 59 seconds.
Exactly.
But if you've got an application, say, related to gaming or creating custom ads in real time, things like that, that's going to have to be more proximate to the user.
And it's got to be fast.
Yeah. So in other words, the amount of time between when you submit the prompt or the request and when it comes back to you is much more important.
Okay. And we're not there yet.
No, mostly.
Yeah.
So I think that as that happens, that will benefit Equinix. It also benefits players like Digital Realty. Digital Realty has not participated in these middle of nowhere data center deployments. They focus on tier 1 markets as well. So I think
so who's doing the stuff in the middle of nowhere? Is it private companies?
Yeah, to a large degree, and also the hyperscalers.
And the hyperscalers.
You've seen again a lot of hyperscale builds. There's less of a willingness on the part of third-party developers to go into these oddball markets because they worry that 10 years or 15 years from now, when the leases come up, if the market changes, they won't be able to release it.
Got it.
So you've seen some private players that are maybe more aggressive, the hyperscalers, and you've seen guys like, this is another interesting angle, but Bitcoin miners repurposing their capacity for high-performance computing.
That was a sentence that was definitely in English. I'm not quite sure I understood it.
All right.
Explain what that meant.
All right, so we'll back up a little bit. So cryptocurrency mining consumes vast amounts of power.
That I know.
And it's not latency sensitive. So you saw firms, again, flock to places like West Texas or North Dakota because there was a lot of power, land was cheap, and they could set up these crypto mining facilities. And what's happened is those sorts of locations have become more interesting to the folks developing AI models because they've got a lot of power in one location.
Right.
So what a number of them have done is say, you know what, we're better off taking this capacity, this power capacity that we're using for crypto mining, and becoming data center operators and leasing this space to folks who want to use it for that purpose.
I see.
CoreWeave is an example of a GPU cloud provider who's
CoreWeave.
CoreWeave, yes. Yeah. They've leaned heavily on some of these reformed crypto miners to get access to.
So they throw the crypto miners out?
Yeah, well, it's
they've been evicted?
That was a voluntary process.
Okay.
Yeah, the Bitcoin miners did it by themselves because they saw there was a better return to be had leasing it out to players like CoreWeave.
See. Okay.
But CoreWeave actually went so far they're trying to acquire a company called Core Scientific.
I saw that. It was about a week ago.
Yeah, a couple weeks ago.
Yeah.
There's Applied Digital, Galaxy Digital. Again, sort of crypto miners are looking to repurpose this capacity.
The company that they're trying to come to. What does that company do that they're trying to acquire, CoreWeave?
Yeah, so again, historically it was a crypto miner.
Okay.
And they procured lots of power in places like West Texas, Oklahoma, Georgia, I believe, and a handful of other locations. And said, this is interesting to players like CoreWeave. So they struck a deal where they would basically vacate some of the crypto facilities that they had built, upgrade them to a more traditional data center spec, and then lease out that space to CoreWeave so they could put their GPUs in.
Okay. I will come to CoreWeave in a second. I mean, if you look at Digital Realty and Equinix this year, the thing that's kind of surprising to me, and I know enough to be dangerous because I have tracked these companies for years, but obviously you know a hell of a lot more, is they're actually down this year. And, if you look at the whole AI, digital infrastructure space, like everything is up.
Yep.
Some of it's up insanely. We could argue whether that's correct or not, but the sentiment for the AI space is huge. And yet here, like if you knew nothing, you would. And I said to you, "What do you think Digital Realty and Equinix have done this year?" You would say, "Oh, they have to be up because everything is so good." So why are these two stocks down?
I think it relates in part to the dynamics that we talked about at the beginning of the discussion, the public market dynamics. So we can focus on Equinix. So Equinix has an Analyst Day every 2 years. They had one in June,
right?
Not far from
I did not attend.
It was at the Time Center, just a few blocks away. But they laid out a growth plan over the next several years. And it involved a substantial amount of CapEx. And when you spend a lot on CapEx, particularly for facilities, retail-oriented facilities like what Equinix offers, so lots of small customers, means it takes time to fill them up. It takes time to get them online. So if you start spending capital to build a new facility today, there is a drag that imposes on your results. Interest expense when you buy the land and start construction, then you bring the facility online. Until you reach a certain utilization rate, you're going to be either cash flow negative or EBITDA negative, or at least below where you were. And they're putting enough money to work that it's actually depressing their AFFO per share growth trajectory in the early years.
Why don't you define for people what AFFO is? Because that is the metric that matters in this space. So,
yes.
So everybody's on the same page.
Yeah. So for real estate more broadly and for data centers specifically, AFFO stands for Adjusted Funds from Operation. And what it's supposed to present is a measure of how much cash flow the companies produce, setting aside growth-related CapEx. So in other words, in a mature state or in a state where they stop reinvesting in their businesses.
How much cash flow does the company throw
What does it spin off?
Okay.
So for Equinix, which has historically grown its AFFO per share, I'd call it a 10% rate or so, at least for the last several years, they expect that to tick down to like a mid-single digit rate next year before kind of
that's significant.
That's significant. Yeah. And then so before going back to sort of 10% or eventually double digits if the plan works. So that freaked people out.
Now, but by the way, if this was a private company, Equinix,
yes,
and this was the plan, this would be approved in a heartbeat.
Yes.
Of course, the opportunity here is massive. Yeah. We have to spend some money in the near term and our cash flow is depressed. Who cares?
Exactly.
But it's a public company. That's the problem.
That's right. And that's why so many of the other operators have gone private.
Right.
Yeah. So I think that what happened with Equinix certainly dragged down their stock. And I think with Digital Realty, they were sort of affected in sympathy. And to some degree, DLR's had a very good run over the last few years. I think it got down to as low as $80 a share or so, and it probably traded up to $180. So yeah, it's down. But
so are the valuations
are
the valuations now roughly comparable in terms of how people value these stocks? Because in the past, Equinix used to sell at a pretty significant premium.
That's right. If you look today on a headline basis, DLR trades at a premium of a few turns to Equinix.
Off of AFFO.
Yeah, AFFO or EBITDA.
Okay.
People look at both. I'd say it's a little more nuanced than that. So with Equinix has higher stock-based comp, which you want to take into account. DLR hyperscale leases tend to be longer than retail leases. So again, retail is mostly what Equinix does and what a portion of DLR does. They have much more exposure to hyperscale leases. The hyperscale rents or the large footprint rents have really been what have skyrocketed. So they've got, Digital Realty has a greater opportunity to release some of leases that are coming up for renewal in its base over time that helps. And they have a proportionally larger development pipeline than Equinix. So Equinix, again, earns better returns on the dollars it puts to work, but because it's a niche, its investment opportunity is more constrained than what you see at other players.
Is Equinix in the hyperscaler space at all, or
so
in a small way?
If you want to, roughly 40%, a little under 40% of cloud on-ramps globally are hosted in Equinix facilities. So what that means is that if you want to access AWS, your traffic is being routed through Equinix.
Okay.
So in other words, if this is an AWS data center where they have all their servers, and this is an Equinix facility, if you want to get here, you've got to run through Equinix. From a hyperscale perspective or from a cloud service provider perspective, it's very efficient to be able to put your gear in a facility where you've got access to many networks, many potential customers. Even if your competitors have their on-ramps there, because that makes it more attractive to the customers that want to use your cloud. And I think they've come to the realization that multi-cloud is how a lot of customers want to approach the architectures. A big enterprise isn't going to lean solely on AWS. They're going to want to use AWS for some things, Azure for some things, Google Cloud for some things, CoreWeave for some things. So being able to put equipment in Equinix and directly access all their cloud providers is very important to them. So Equinix's largest customers are the hyperscalers, but it's a much smaller share of their total revenue than what you would see at others.
Okay.
They have a much more diversified base of business, but hyperscalers are a key magnet to get customers into Equinix.
So would you say it's fair to say that when, not if, but when there are a tremendous number of AI apps, that's going to be the time when Equinix shines?
Yeah, I think that'll absolutely help their business. Again, I think it'll be the more latency-sensitive apps or maybe private AI deployments, meaning customer doesn't want to use the public cloud to do it for whatever reason, security, privacy. You've seen some, Equinix gave an example of Bristol Myers, for example, putting a private GPU deployment in one of their facilities for that reason. I think that'll benefit Equinix's business. It's never going to lead to the sort of like rocket ship results that you've seen at some others, because Equinix has a very diversified business. Cloud adoption, multi-cloud adoption, that's still a big growth vector for Equinix. Networking is a big vector. Financials, right? Equinix will host like the BATS exchange in Secaucus. So everybody goes to Equinix Secaucus because they want to access the trading exchanges. So they've got multiple pillars of their business, of which AI is one, as opposed to say, a CyrusOne or QTS, which is disproportionately benefiting from AI as a growth driver.
Because they're so hyperscaler oriented.
Yes.
Okay.
Yes.
Let's talk about CoreWeave for a minute.
Sure.
And then I want to talk about power or the lack of power.
Okay.
So when did CoreWeave go public?
It was the end of March.
Okay. So it's a fairly new company. And yet when I go on to watch CNBC every single day, I don't think a day goes by that company is not mentioned.
I think that's right.
So why don't you tell people, what exactly does CoreWeave do? And why do people care so much?
Sure. So CoreWeave operates a GPU cloud. So a GPU, graphics processing unit. So those are the chips that are really necessary for training and inferencing AI models.
Okay.
So they've been in high demand from the hyperscalers, or from OpenAI, Anthropic, and so on. AWS, Azure, GCP, Google Cloud, they operate more general purpose clouds. So more think of it as traditional storage or compute with CPUs. Now, they obviously play in the GPU space in a big way, but CoreWeave is purpose-built for AI, purpose-built for GPUs.
So let's some definitions here.
Sure.
So Digital Realty and Equinix, they own the building.
Yes.
But they don't actually operate what's in the building.
That's correct.
But CoreWeave owns the building or leases the building.
To date, CoreWeave has exclusively leased its facilities, and it owns the equipment
And
inside.
it owns all the equipment inside,
Yes.
which is exclusively GPU oriented.
That's right.
So it's the newest version of a data center. That's what they operate.
Generally. They'll have some smaller clusters in, older facilities, but they're working with a lot of partners to build facilities that are, call it, with AI specs, so much higher power densities, liquid cooling,
Right.
Stronger floor
Totally
plates to hold the weight.
state-of-the-art.
Yes. Yeah. So they operate GPU cloud. In terms of their customers, Microsoft is currently their biggest customer.
What percent of their customers is Microsoft?
Recently, it's 70%.
Wow.
Now, that's going to shift in the coming years because they've signed some big deals with OpenAI. But it's interesting because, go back a few years and Microsoft was struggling to bring on as much GPU capacity as its business needed, in large part because it worked with OpenAI. It leaned on CoreWeave to help. CoreWeave had a good relationship with NVIDIA. Right? NVIDIA doesn't want to only sell GPUs to the big cloud providers. They want to seed some new providers. And CoreWeave really seized the opportunity and built a business from next to nothing to something quite substantial.
How young is the company?
It's several years old. I'll go back.
Define several.
I think they started in 2017.
Oh, so it's pretty new.
As a crypto miner.
As a crypto miner.
And that's how the management team learned about AI, because crypto mining uses GPUs.
Yes. Okay.
They really.
So they started out over here and they ended up over here.
But what's really fascinating is CoreWeave in 2022, their revenue was about $16 million.
Wait, it said 2022, the entire revenue of the company was $16
million. About as much revenue as 2 Chick-fil-A locations produces. Okay?
And that is accurate.
That is accurate. In 2025, $5.3 billion.
Oh my God.
And if you looked out to 2028, so 3 years hence, it's probably in the mid-20s.
Billion.
Yeah.
Revenue.
Yes.
Okay. They don't make any money yet.
Yeah, well, it depends on how you define it.
Okay. But good old-fashioned earnings per share.
Yes. No. But, you've had other very fast-growing companies in history, but those tend to be more like intellectual property. What's really interesting about CoreWeave is that they've grown this quickly with, and it's an infrastructure business. So their CapEx has been
astronomical.
Like this year, I think they're spending 21 to 23 billion in CapEx.
Let's boil it down for a second. A new GPU GPU facility that CoreWeave's created. It's from the de novo. Here's the land. We're going to build it up here. What does that cost? Just one facility.
Well, depends on the size of the cluster.
Right.
A different way to put it might be if they signed a contract with OpenAI for, I think it was $14 billion in total. It was like 2 pieces. I think it was 11 and another 4. So maybe 14 or 15 billion total contract value over 5 years. It might cost them, if I remember correctly, 40 billion or so in equipment to support that contract.
40 billion to basically put all the stuff that needs to go into the building.
Yeah. I mean, it's shot. In just a handful of years, their capital budget is in the same league as AT&T, Walmart, ExxonMobil.
Right.
It's crazy.
I'm going to repeat that again. 2022, 16 million in revenue.
Yes.
And today, 5 billion in revenue.
5.3 this year. Yeah.
It's frightening. It's unbelievable.
Yes.
This is where I personally have always had a problem with high-tech growth companies in terms of like how do we even begin to fathom the valuation. So when you look at CoreWeave, how do you even think about value? I mean, you've got a company whose revenue is exploding.
Yes.
Doesn't make any money yet.
Yes.
But the growth opportunity is enormous.
Yes.
Walk us through just conceptually, how do you even begin to think of, okay, I think this thing could be worth X because of Y? Like walk me through that process.
That's a terrific question.
Because in bank world, we just say what's my tangible book value?
Mm-hmm.
And, depending upon the return on equity of the company, that'll tell me what multiple of tangible book
Yes.
value. End of discussion. Walk me through your thinking.
Yeah, so
here.
what's fascinating here is there's nothing else like CoreWeave out there,
Right.
either in terms of the business model or its the size. What a lot of my peers have done, which I would not endorse, is they've looked for other names sort of that are tangentially related,
like
data center operators,
Like
Equinix,
Equinix.
or Microsoft, Google, and sort of slapped a multiple on CoreWeave's results. A few years
what
ahead.
result are you slapping a multiple on?
Yeah, either operating income or EBITDA.
They do have EBITDA.
Yes. Again, because their cost is all it's the GPUs, it's the CapEx.
Right.
So their EBITDA margins are probably 65% or so, but they're obviously a lot of depreciation expense that weighs on operating income. I think that's totally the wrong way to look at this business.
Let's just backtrack for a
Yes.
second. So if CoreWeave buys $1 billion worth of GPUs, et cetera, that's not part of EBITDA. What is part, that all the depreciation from all that stuff is added back to the EBITDA.
That's right. That's right.
So in a way,
But it hits operating income.
it hits operating income.
Yes.
But if you're valuing the company on the EBITDA, in some respect, you're not taking into account what it's costing you to create this thing and what return you're expecting to get on that. That's the weakness of it.
Yeah, it's a silly way to look at it.
Right.
I think what you need to do is look at the unit economics of a deal. So a GPU, it remains to be seen exactly what the economic life of a GPU is. CoreWeave depreciates them over 6 years. Like I said before.
The chips.
They signed that deal with OpenAI, which is arguably the most sophisticated user of chips out there. They signed a 5-year deal with 2 one-year renewal options. So they've got some life to them. But at the same time, you're still in a supply-constrained market. NVIDIA is trying to increase the pace at which it releases new chips. So it's a bit of a question mark as to how long these things are going to be economic. But what CoreWeave does to reduce that risk to some degree is they will sign multi-year deals with their customers. Let's call it 4 or 5 years of locked-in revenue. And then at the end of the term, they either try to contract it out again or rent it on a spot basis. But the approach that I took is to say, okay, what are the unit economics of these deals? You collect some cash up front. You have a lot of CapEx up front. You've got locked-in revenue for a period of time. You've got data center rental expense, power costs, and so on. And then at the end of the deal term, you have some ability to potentially squeeze some more juice out of these things towards the tail end of their lives. My sense is that for every dollar of CapEx they spend, they're probably generating something like 15 to 20 cents in value, in net present value terms. So I kind of look at it
Think of that like as a return on invested capital.
Exactly, yeah.
So for every dollar that they buy, simplistically, for every chip that costs them $1, they make 15 to 20 cents off the chip.
Yeah, over the life of the contract.
Over the life of the contract.
Present value, their net benefit is 15 to 20 cents.
Okay.
So the way that I've tried to approach it is, how much CapEx do we think they can put to work over time? What's sort of a steady state that they eventually reach? And think of that value creation as a mechanism to value the company. It's a bit of a nuanced approach, but I think for something that's growing this rapidly in a new space, it struck me as the logical way to do it, even if it's not a traditional
So
approach.
what kind of valuation do you come up with, or range of valuations do you come up with for CoreWeave?
Yeah, so our target price, we just updated to 65. And the stock's trading, it moves a lot. Yesterday it was around 90.
Okay.
So we're a bit below. I think, the stock is growing like a weed. At the same time, and I think they've done a great job of seizing the opportunity to position themselves as an alternative to the big cloud providers. At the same time, I think that the big CSPs are big battleship businesses.
What's CSPs?
Cloud service provider. So I think AWS, Azure, GCP. So I think in time, they've been a bit slow out of the gate, a little bureaucratic, but they have essentially limitless resources. And I think they'll get better in this space. I think chip constraints are easing. I think net, that will probably put some pressure on CoreWeave's returns over time.
So what you're saying is that right now, because of the shortage of chips and CoreWeave's good relationship with NVIDIA, they have this kind of competitive advantage to seize the GPU data center space. But the other guys are going to come.
Yes. I mean, and I think CoreWeave is a legitimately good operator. Operating these clusters is not easy, and I think a lot of people will think of CoreWeave as simply buying chips from NVIDIA and releasing them. But there's really an operational component too that differentiates them, and they've been good on that front.
What's the operational component?
Well, if you've got tens or hundreds of thousands of GPUs in a data center linked by hundreds of miles of fiber, and the chips tend to have relatively high failure rates. You have to have the right networking equipment.
I haven't heard that before. What's the failure rates of these GPUs?
Yeah, you get different answers from different folks.
I'm sure you do.
But whether it's because of the heat they produce or simply the complexity of the system, they tend to go offline at a faster rate than CPUs. Now, in some cases, it's a matter of tweaking it to get them back online. In some cases, they literally burn out, and you got to replace them. But it's much more complicated to operate a GPU cluster than a traditional cloud.
Okay.
So they've done a good job there. But yeah, I think that in time, the incumbents will be more effective here. I think chip supplies loosen up, and that probably weighs on pricing and returns to some degree. And from a buyer perspective, like OpenAI is probably going to be CoreWeave's biggest customer in the coming years. So you got to believe in OpenAI. Now look, they're clearly a leader from a tech perspective. They've created software that could change the world. They're also very cash flow negative. You could see models like DeepSeek or other open weights models come out that maybe aren't as good as OpenAI, but they're fast followers, which could, impact OpenAI's ability to monetize its frontier models. Or if you believe that OpenAI becomes, the clear leader, it kind of gives them monopsony power in terms of buying who they buy chips from.
Right.
So, whether they've done that already. They buy from Microsoft, they buy from Oracle, they buy from CoreWeave. So there are ways to manage that to ensure that your suppliers don't generate excess returns at your expense.
So let's change gears for a second. Switch to a topic that's not technically under your coverage, but if it's not solved, your coverage is going to go down the toilet bowl.
Yes.
Which is power.
Sure.
Walk us through the landscape now of every day you hear stuff about nuclear getting involved, people. Bloom Energy. I mean, the list is endless. Walk me through the landscape of how much is this industry growing so that the power capacity of the United States is not going to meet it? What are people doing to try and get power? Where are we?
Yeah, I think if you look over the last several years, I think the data center in the U.S., data center capacity has probably grown at like a 15% CAGR or so. And projections, obviously wide ranges, but maybe 20% is a reasonable benchmark.
Okay.
Now, within that, you've got the AI component growing a lot faster. You still have growth from cloud. And then you have some older applications that aren't really growing. But that's kind of how you get to that sort of forecast. The data center industry in the U.S., I'm going to say, is in the 25 gigawatt range in terms of installed capacity today. I think the total generating capacity in the U.S. is probably 1.25 terawatts, so 1,250 gigawatts. Now, obviously, generation is lower because power plants don't run 100% of the time. You've got peaker plants and solar and whatnot that are more sporadic. But I think data centers are probably a low single-digit percentage of power consumed in the U.S., and that's going to grow. Again, a lot of challenges in terms of getting the generation online, the transmission online, the equipment for substations to support all that. My hunch is that we live in a market economy, and it responds to signals. And you see things like capacity auctions at PJM, which is the organization that runs the power grid, and a lot of the Mid-Atlantic, including Virginia, which is the biggest data center market. Have capacity auctions at the prices that just seem to be like screaming for people to come in and build generation. So I suspect that in time we'll see more balance there. You're seeing data center operators go try to circumvent the utilities in a way.
And how so?
So, for example, build your own generation. Buy gas turbines, put a data center near a gas pipeline, and generate power yourself until you can get a grid connection.
So buy the gas turbine, operate it yourself.
Yes.
Create your own mini utility.
Yeah. I mean, it's not what they want to do, but it's what they need to do.
What they need to.
But look, I think it creates an interesting question for the data center operators because if we go back to what we were talking about before, it's been this supply crunch that has allowed players focused on the hyperscale facilities or their corporate facilities to generate better returns. If we see power supply come more into balance with demand, I think we probably see a reversion to what we had before, which is returns much closer to the cost of capital for that piece of the industry. So in a way, lifting supply constraints really helps from a volume perspective, but it hurts returns. So from a value creation perspective for the industry, it may not be ideal. I think if I were a data center operator focused on that part of the market, I'd want supply to remain tight because that's my stick to get better pricing and returns.
I see. Okay. So you're not all that worried about that the energy needs will be met?
Well, look, I think in time, I mean, it's clearly tight and people are working around it. Mm-hmm. You see some projections for like hundreds of gigawatts. There's actually a lot of double counting in those numbers or a lot of uncertainty there. I'll give you two examples. Let's say a customer is looking for a big deployment in a given geography. They might go to 4 or 5 different data center companies and say, hey, what can you do for me? Well, then they all turn around and go to the utility and ask for what the utility can do.
Right.
So the utility gets 5 requests that really
for
represent
just one customer.
Or, let's say that, you and I wanted to get into business and we went to Wyoming and we bought a ranch that was next to some power lines. And then we went to Wyoming Power and we said, hey, we'd like 2 gigawatts, please. Well, that's not a real request. We're speculative buyers. So there's a lot of speculation or double counting in some of the bigger capacity numbers that you see in terms of the requests the utilities are getting. So they're trying to take steps, to filter out what's real and what's not, or to put conditions on players like, well, if you want to do this, you got to put skin in the game and pay for the study to support the, to support a potential expansion to your site, or you got to pay for the substation, which is not an insignificant sum.
So let's finish up. The other companies that you cover, any of them that are relevant to this conversation?
Sure. So we talked about the data centers that I cover in CoreWeave. I think as it relates to AI, some of the fiber operators are, in the same league. Because like we said before, you got to move data in and out of data centers, right? If you didn't have fiber going to a data center, it's useless. Useless. So at least within my coverage, you've got Lumen Technologies and Cogent, which are big suppliers of fiber that stand to benefit from these trends. If we drill down into each one a little bit, so Lumen,
isn't that like a $5 stock, Lumen?
Well, it's probably 4 and change now. A year ago,
I was close.
a year ago it was $1.
Okay.
So
why is it a $4 stock? Because that's not a good sign.
Yes. So Lumen,
they provide fiber optics.
That's a big part of their business.
Okay.
Yes. So Lumen, you might remember Level 3.
I do.
Yes. So Lumen used to be CenturyLink, which merged with Level 3 to become Lumen.
Okay.
But really, the most interesting part of their business is the old Level 3 network. Level 3 was built during the telecom bubble, right? To build, they built a national long-haul network with a lot of conduits in the ground. So conduit is basically a pipe through which you can pull fiber. And on most of the routes, on most of the city pairs, they built between 10 and 12 conduits, but only used 1. The idea being that the real cost of a network is putting this stuff in the ground. So if they ever needed to expand it or add fiber in the future, they could just pull fiber through the empty conduit at a very low cost. Those extra conduits basically sat unused for 2.5 decades.
2.5 decades. This is a 90s story. I remember this.
Yeah, Level 3 was late 90s.
Yeah.
Now during that time, the business wireline space, which is the bulk of Lumen's business, is very competitive. And you've seen declining revenues, probably for the industry at 3 to 4%. Lumen's declined more. A lot of legacy revenue there. Highly levered. It was a tough situation for Lumen. With the AI boom, suddenly the hyperscalers want a lot of fiber to tie together these facilities because the traffic needs are a lot greater. Lumen was the best option to deploy long-haul fiber quickly because of these conduits. And they very quickly struck deals with, I think it's a total contract value of $8 or $9 billion with all 4 of the hyperscalers to pull fiber through these empty conduits. Mm-hmm. And suddenly Lumen's financial profile looked a lot more interesting.
Okay.
And they sell other products that hyperscalers or other AI-driven entities are using, like wavelengths. Not sure we're going to get into the weeds on that, but other products that are interesting. So they're arguing that they can take a business that's been declining for a decade
or more.
Yeah, and turn it to pivot to growth in the coming years.
Okay. And what do you think?
I'm a little skeptical. I think that the competitive dynamics are tough, and there is a big base of legacy revenue there that will continue to weigh on results. Look, I think growth will improve, but not as much as the company articulates. Cogent is another one. Cogent's an interesting story. It's the smallest company I cover, but we could spend
What's
an
the
hour.
market cap?
$1.5 billion.
Tiny.
Yeah, it's tiny.
It's not a $4 stock, is it?
No. But they've had a very rough year. But to focus on the AI piece, a couple of years ago, they acquired the old Sprint network from T-Mobile.
Okay.
Right. So remember the pin drop network.
Right.
So one of the first alternative fiber networks built in the U.S., employed mostly in the 80s. And the idea there was to take that network, which was built for voice, and essentially repurpose it to offer wavelengths. So again, wavelength, a point-to-point high-capacity transport product. It's again popular with hyperscalers and other network service providers and big enterprises. But that's again, wavelengths as a product has really benefited from AI. So I think Cogent has been a little rocky start, but they've effectively converted the Sprint network to offer waves, and they've come into this market that has historically been dominated by Lumen and Zayo. So they're coming in as a third provider, and I think they have a number of interesting advantages that should enable them to grow their wavelengths business into a meaningful EBITDA and cash flow contributor.
Do you like
in
that
the coming years.
stock?
I do. I've been wrong the last couple of years, but I think it's pretty interesting.
Okay. Well, this has been great. Thank you, Nick. That was really, really informative, and hopefully we'll have you back.
Yeah, thanks for having me, Steve.
Thank you. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.